Allow me to greet you once again. I will be recording Demba Pty Ltd, which is a medium-sized enterprise. And in this question, I will only be focusing on two questions, or in this question paper, I will only be focusing on two questions. Some of the questions I have been recording on them many times. So my focus will be on the second requirement to give you in the order of the priority, which is the preparation of the actual income statement of Demba for the quarter ending 30 June 2007 on an absorption costing basis. So now we are to prepare this actual income statement using the absorption basis. And we are to show the amounts for Kilimanjaro and Amazonia and the total in separate columns. And they gave us the example, the sales and the cost of sales for this product separately in one column, and for this one, and also the total column. So this is what we are required to do. First requirement, which is priority number 2 in terms of what I think is importance. It says ignore the implications of the opening and closing finished inventory values and determine the total budgeted number of tiles for each of the products that Demba needs to sell in order to break even for the quarter ending 30 June 2007. Now this is obviously calculating the break-even point in units, and very important to highlight it says determine the budgeted number. In the next question, prepare the actual. So now this will be based on the actual information, and this will be based on the budgeted information. So it is very important to be mindful of that. Other questions were required to calculate the variance, selling price variance, and direct material efficiency, sales commission expenditure variance. So those variants are very important to know, but I will not be recording the variance in this question, so that I've done many questions where there is variance analysis. Maybe I can just only extract this variance later on and do a very short question. Yeah, if you go through my previous videos, you'll see that I've done a lot when it comes to variance analysis. But my focus is not on that, it's on the two questions that I've highlighted now, which are the major big questions in this question paper. But in my analysis of the information, I will be partly responding on the variance at the same time. It says Demba Pty Ltd is a medium-sized entity that manufactures and distributes ceramic floor tiles to all major tile wholesalers and retailers. Demba's manufacturing capacity or facility is situated in the Randfontein area near the mines, where most of its direct raw materials are mined. The company manufactures two types of ceramic floor tiles, which are named Kilimanjaro and Amazonia. So these are their two products. Demba operates on a variable costing system. That means they are only using, or they are only adding variable production cost to calculate the cost of production. Therefore now fixed cost becomes period costs. Therefore now, and it is very important to note what system is the company using. They are using variable costing, but now we are required to use absorption costing. So that means the company is moving from variable costing into absorption costing. The income statement is for the absorption costing basis, not the variable costing income statement. So now be mindful of that. There might be some information that is very crucial because of the fact that we are moving from one system to another system. It further says that and all its types of inventories are valued using first in first out basis, and Demba's financial year ends the September 30th each and every year, and the manufacturing and the sales of all these tiles occur evenly throughout the year, meaning equally every month they almost manufacture and sell the same number of units. Demba's financial manager produced the following extracts from the budgeted and the actual management accounting records for the quarter ending 30 June 2017. That means a quarter started 3 months back but is ending in September. It's ending in June 2017. I'm just thinking of the 2 days now. End of the year September, but we are focusing on the quarter that ends in June, not necessarily the end of the accounting period. Then we are given 2 columns in terms of the information. We are given columns for the budgeted information and column for the actual information. It is very important to be mindful of these 2 columns, that our information is provided in totals. The information is provided in totals, not per unit. We can see that we have our sales as 4,628,000 budgeted, and our actual sales are 4,716,000 actual. So now this is the information that is provided to us: direct material, direct labor, variable manufacturing overheads, packaging cost. We know that packaging cost will vary with the number of units that are manufactured. Then selling and distribution cost. Most of the times this cost gets to be divided. I would say most of the times, not all the times. This cost gets to be divided into fixed and variable. It's normally a combination of these 2 costs. Another portion of this is normally fixed, another one is normally variable. So now we need to listen to the information that is provided to us in terms of how to split the fixed part and the variable part from this selling and distribution cost. We are provided with a fixed manufacturing overheads of 756,000 and 766,000, which is actual information. And we know that in order for us to calculate break-even point, we say total fixed cost. We calculate our fixed cost and we say divide this by contribution per unit. So now our fixed cost must be in total. We are already provided with the budgeted fixed cost, which are manufacturing related, but we don't know if there is no fixed component here or not. So now we still need to look for that information and calculate or deal with it accordingly. We have information that is additionally provided to us, which says Demba budgeted to manufacture 24,000 units of Kilimanjaro tiles and 18,000 Amazonia tiles. And these budgeted units are equivalent to 80% of the company's total quarterly manufacturing capacity. So now these units of 24,000 is not the quarterly normal capacity because it's 80%. That means 24,000 divided by 0.8 will tell us that the normal capacity for the quarter of the tiles called Kilimanjaro, it is 30,000. And for Amazonia is 18,000 divided by 80%. That will be 22,500 normal capacity for a quarter of this product. But that information might be needed or it might not be needed. We don't know as per yet, but it's very important to just do those calculations. Then it says the actual manufacturing volumes for the quarter were 22,500 Kilimanjaro tiles and 20,000 Amazonia. So now this is the actual production. Remember, everything that is actual must go to the actual income statement according to the absorption method, which is our requirement. So now we are looking for what is actual and also looking for what is budgeted. So be mindful of those actual and budgeted, because we are to calculate budgeted break-even point and also calculate the actual income statement using the absorption costing system. It says number 2, Demba had opening finished goods inventory of how many units? 1.8 and 800 for the 2 products on the 1st of April. Remember, April is the beginning of the quarter that will end on the 30th of June 2017. So it will be April, May, June, end of the quarter. Remember, a quarter is made of 3 months and there are 4 quarters in a year that are made of 3 months, 3, 6, 9, 12. there are 12 months in a year. These units were valued using the variable costing system at 104,000 and 56,000. This is very crucial to be mindful of. That means the opening inventory value does not include fixed cost. This is what it means, because it was valued using the variable costing system that the company is currently using, because it was before they moved from the variable costing into the absorption costing system. That means we still need to say plus fixed cost here, plus fixed cost, because we are to do the income statement using the absorption costing, and absorption costing must take into account fixed cost. So we need to know what is the predetermined overhead rate for the previous year, meaning for the this previous accounting period. So now we need to know that 2017. So when we get there, I'll remind you of that. Then after we say Demba had no opening or closing inventories of the direct raw material and work in progress tiles. And it's very important this to be highlighted, because now we start processing the raw material first into becoming a product. And when it's not finished at the end of the year, that is inventory of the work in process, which is opening inventory of work in process, plus material, plus labor, plus our overheads that are applied. So I don't want to go there, but this is important to highlight that there was no opening, neither closing of the work in progress, and opening and no closing of the direct material. Number 4, we are provided under number 4 with the sales information, which is given to us as budgeted sales 24,920 and 17,800. This has to do with the break-even point if we need such. We have our budgeted sales mix. Remember, why budgeted? Because when we calculate our contribution, we must calculate it on the budgeted information, because our break-even point is on the budgeted information. Our sales mix is 1.4 and is to 1, and I've explained the sales mix in the previous videos, how you derive the amount of their sales mix. Actual sales volume is 23,000 and 19,500, meaning these are the actual sales volume, meaning the actual units that were sold. Actual sales volume, we sold 23,000 and 19,500. Remember, our production was how many units? We produced 22,500 and 20,000 for the second tile type called Amazonia. That means now we can say our production plus our opening minus our sales to get to our closing inventory. Now let us do that immediately. Opening inventory is how many units? Opening inventory is 1.8 and 800. Then we can say 1,800 plus production of 22,500. This is what we have produced, 500 for Kilimanjaro, minus units that were sold. How many units were actually sold? Our actual sales is 23,000. We say minus 23,000. How much do we get? Just erase there. We get to the figure of the closing inventory as 1,300 units, meaning closing inventory is 1,300 for Kilimanjaro. Second product, we say opening plus production. We produced 20,000 units of Amazonia actual, then we plus 20,000. We minus actual sales, units that were sold 19,500 minus 19,500, just use minus twice there, minus 19,500, we get to 1,300. So we can say that our closing inventory is the same for both of the product in terms of the number of units. Closing units that are completed is 1.3 for both of the product. Then now we need to look at the budgeted selling price. How much did we budget to sell our inventory for? We budgeted to sell it at 100 rand, but we actually sold it at 105, the actual selling price. The second one we budgeted 120, but we actually sold 118. The variance for the first product, it will be favorable, and the variance for the second product will be adverse because we sold our inventory at a price less than what we anticipated for the second product. But for the first product, we sold our inventory at a price higher than we anticipated or budgeted. That means we would have made a higher profit than we expected. But for the second one, we would have made a lower profit than anticipated, which is unfavorable for the business. Now, we go to number 5. Number 5 says the budgeted data. Remember, anything budgeted has to do with the break-even units. Or break-even units, yes. Budgeted total direct material cost is 30 Rand for the Kilimanjaro. Now let me go and do my calculations immediately. Why am I doing this? Is because we need to calculate first contribution per unit before we calculate our break-even point. So now let me calculate my contribution per unit. I'm looking at the contribution per unit for Kilimanjaro and Amazonia. Then we have our selling price. Remember, we are looking for the budgeted selling price, 100 Rand and 120. We are doing the budgeted contribution. So now our selling price must be the one that is budgeted, which is 100 Rand and 120. Then after, we need to minus our variable cost, less our variable cost. Our variable cost, we have material, which is direct material to be specific. Direct material. Our direct material per unit of Kilimanjaro, which is a variable cost because we know that all the direct costs are variable, is 30 Rand and 36 Rand that is budgeted for Amazonia tiles. Then we record that 36 Rand for the Amazonia tiles. Then we come to the next column. The related actual cost. We don't need the actual cost. Why? Because the actual information is needed for the second requirement. Just want to remind you of that. Very important to memorize the questions. The actual income statement. Determine the budgeted number of tiles that will be at the break-even point. So now everything budgeted has to do with the break-even point, and everything actual has to do with the actual income statement using the absorption costing system. Now I just wanted to remind you of that, as opposed to saying it several times. Maybe you don't remember it. The actual data was 32 Rand per unit and 38 Rand. Now when we look at the material price, we estimated to buy 32 Rand, but we estimated 30 Rand, but we're buying at 32. This will be adverse, unfavorable variance. This one we estimated to buy at 36 and we bought at 38. This will also be adverse variance. Standard price minus actual price, term this by the actual quantity purchased. So now this will be what you do. And again, standard price, meaning budgeted price, minus actual price, multiply this by the actual quantities of material that were purchased. But I am not there. I'm looking at the budgeted so far. Now this is the material price variance now that I'm analyzing. Number 6 says Demba employs 50 tile makers at 30 Rand per hour. Now, meaning we are coming to the direct labor cost. We are coming to the direct labor cost. And our direct labor cost is 30 Rand per hour. We need it per unit, not per hour. Now, if our employees are being paid 30 Rand per hour, and 25 of whom work exclusively on each type of the tile, budgeted direct labor time to manufacture its product is 30 minutes. For which product? For Kilimanjaro. So now we need to know how many minutes or time does it take to complete one product. Then we say 30 Rand multiplied by 30 over 60. So now we say 30 minutes over 60 minutes, multiply this by 30. it gives us 15 rand. That means the direct labor cost will be 15 rand for product Kilimanjaro. Let us look at the number of minutes that it took for the second product to be completed. We can see that they took 40 minutes to complete Amazonia in terms of budgeted time. So now we say 40 minutes divided by 60 minutes, it means they took 0.66 hours. Multiply this by the rate per hour so that we get the cost of labor per unit. Therefore, now this gives us an amount of 20 rands. Then we go to the second or to the next one, or let me continue to this one and clarify something again. The actual, remember, actual relates to the actual income statement, not the budgeted break-even point. The actual time was 32 minutes. That means they estimated that it will be 30 minutes, but they took 32 minutes. Therefore, now labor efficiency in this case will be unfavorable for this product. Another one, they estimated 40 minutes, but they took how many minutes? They took 36 minutes. That means the labor efficiency for this product will be favorable. Standard hours minus actual hours, multiply this by the standard rate. So that will be the labor efficiency variance. Now we go to the number 7, information, where it says the budgeted variable manufacturing overheads per tile was 12 rand for Kilimanjaro and 14 rand for Amazonia. So there is 12 rand and 14 rand, which is variable manufacturing overheads. Manufacturing overheads, we have 12 rand and 14 rand. So we do have the 12 rand and 14 rand. Then we go to the next one. The next one says the actual cost. We know that actual cost relates to the actual income statement according to the absorption costing. It will be 11 rand and 13 rand. Again, now the variable overhead price variance, it will be 12 vice versa 11 and 14 vice versa 13. This will be we paid less. This will be a favorable one. This will be again a favorable one. We overestimated our variable manufacturing overheads, which led to the variance being favorable for both of the products. Then now we go to number 8. Number 8 says the budgeted and the actual, meaning in this case we have both of them in one sentence. The budgeted and the actual packaging cost per tile was 8 rand for Kilimanjaro and 10 rand for Amazonia, meaning what they budgeted was the same as the actual data. So now that means it will be 8 rand and 10 rand for the packaging cost. Is it packaging? Yes, 8 rand and 10 rand of the packaging cost. So we say packaging. We have 8 rand and 10 rand. Then let us continue to the next cost that we have. We are told that the budgeted and the actual selling price costs consist of both fixed and variable cost. I did mention that our selling and distribution is a mixed cost. There is a fixed component and there is a variable component. So now let us look at the fixed component and also the variable component. They say the variable cost component relates to the sales commission. Sales commission of 4% of Kilimanjaro tile and 5% of on Amazonia tile is calculated on their respective budgeted and actual sales price. Take note of that. Meaning the budgeted portion is 4% of the selling price, and the budgeted variable portion, it is 5% of the selling price, together with the actual variable portion of our selling and distribution cost. So now let us look at the variable selling and distribution. Selling plus distribution cost. It is said that it is 4% of the price. of the selling price, 4% of the selling price, meaning 100 rand, our budgeted selling price, because we are dealing with the budget. Multiply this by 4%, it gave us 4 rand, and again 0.05, multiply this by 120, it gave us an amount of 6 rand. So now we have done and dealt with that cost, which is in this case the variable component of the budgeted selling and distribution. Then it says Amazonia tile is calculated on their respective budgeted and actual price. Okay, we have done that. Fixed selling and distribution costs are allocated at a ratio of 3:2. Take note of that. Fixed selling and distribution costs are allocated at the ratio of 3:2. So now that means our fixed distribution, let me just deal with the budgeted so far. Now we have our budgeted that is given to us here, and we know that our selling and distribution, it is 431,000. Now let us look at the variable part, because we have two components, fixed and variable. We have fixed cost, we have the variable cost part. The variable cost also must be divided into 2. Now we know that we have 4 rand that is budgeted, and 6 rand that is budgeted on the number of units that are budgeted to be sold. So now 4 rand minus 4 rand, multiply that by our budgeted sales. We say 4 rand, multiply this by 24,920. We get 99,680. 99,680. Now this is the budgeted variable part, 99,680. Then we come to this side, we say 6, multiply 6 by budgeted sales 17,800. We get 106,800. We get 106,800. 106,800. This is what is budgeted in terms of variable selling and distribution. Therefore, now what do we do? Now we say, okay, our total selling and distribution variable will be plus 99,680. This gives us a total of how much? Gave us a total of the variable part being 206,480. So now we say this is the amount minus the total of 431. Let me check if it's 431. Yes, minus 431,480. 431, 480. So that means the amount of 225,000 is the fixed portion. 225,000 is the fixed part, and the fixed part is divided now into the ratio. That's what I wanted to explain. The 225,000 is divided now in the ratio of, where is this ratio? In the ratio of 3:2, according to product Kilimanjaro and Amazonia. So now we can split that to 25,000 where necessary, but we don't need to split now, because our break-even point, we only need one total fixed cost for all the products. So now we have highlighted that. Take note of this. It says absorption costing system. So we can stop there so far and respond to question 1. And before we do absorption, therefore now we'll need to come to the heading that says absorption, because all the information has something to do with the absorption information. Now we have taken into account all the costs that are variable, and from here we can draw our line, and we have Total variable costs here, where is 30 rand plus 15 rand plus 12 rand plus 8 plus 4, it gave us a total of 69 minus 100. Contribution is 31 rand. 36 plus 20 plus 14 plus 10 plus 6, we get 86 minus 120, we get 34 rand. This is our contribution per unit. Contribution per unit. We multiply this by sales mix, which is 1.4:1. I hope you remember that one. Then we will get to our weighted average contribution, or our contribution per unit. Then it will be 31, 34, remain 34. 31 times 1.4, we get 43.40 plus 34. This is what we are looking for, weighted contribution per unit. Average contribution per unit. So now this will be how we calculate our contribution first of all. Then after we have calculated that contribution for two products, then now we can do our break-even point. We can do our break-even point, which is fixed cost. How much is our fixed cost first of all? We have two fixed costs that we need to be mindful of. Fixed cost, which is 225,000. The one that is from the variable selling, 225,000 is our fixed cost. Then there's also fixed manufacturing overheads of 756,000. So we add the two 756,000 plus 225,000. 756,000 plus 225,000, we get 981,000 as our total fixed cost. 981,000, divide this by our weighted average contribution per unit, 77 rand 40 cents. This gives us 1,000 or 12,674. Then when we want for each product, then we say Kilimanjaro will be 12,674. Multiply this by the sales mix 1.4. Then Amazonia, we say 12,674. Multiply this by 1, it will give us the same 12,674. Multiply this by 1.4, it will be 17,745. So now this is how you would have calculated your break-even point in units. This will be break-even point per batch. Break-even point per batch. So now this will be the first requirement. That is very important. And now one thing that is very important also to be mindful of in terms of just explanation, the sales mix, but I did explain previously. For every 1.4 units sold for product Kilimanjaro, there is 1 unit sold for product Amazonia. That is what the sales mix means. So now we have clarified each other in terms of these calculations. Therefore now we must come to the second requirement. Now let me leave all these workings as they are. because some of them will be necessary in my continuation of the calculation that I will be doing for the absorption costing system. Now we are doing the second requirement, which is the absorption costing system. Let us begin. Absorption costing, we know that we deal with sales minus cost of sales. So we say sales, we have two products, there must be three columns in fact. We have Kilimanjaro, we have Amazonia, then we have the total column. I hope space will be enough. We have our sales minus cost of sales. Then sales minus cost of sales. Our cost of sales are made of the opening inventory. They are made of the units that were produced at total cost production minus closing less closing. In this case, the over or the under will be after this calculation is done. Then we have our plus or minus over or under recovery rate, over or under recovery rate. So now I want to simplify this like this, straightforward, sweet calculation. Now let us look at our sales first. How many units were sold and at what price is our actual price? Remember, now we're focusing on the actual information, not budgeted. Anything budgeted, that's not for us. We focus on actual. Now, before we focus on the actual, very important is to read this information that relates to the absorption costing. What are they telling us that is new? After having been appointed to the Chief Financial Officer position, that is wow, Ms. Setsebi Baloyi, CS of South Africa, reviewed the June 2017 quarter and actual results and then indicated that Demba's current costing system does not comply with the International Financial Reporting Standards, IFRS, and International Accounting Standards 2. She immediately requested the financial manager to investigate the possibility of changing to the absorption costing system. Below is the outcome of the financial manager's investigation, and the fixed manufacturing overhead cost must be allocated to the tiles on the basis of the total annual manufacturing capacity in units. Then after, they are telling us that, and this is very important, but we are not given information that will necessitate us to use this information. In most of the question, they will say your POR must be calculated using the normal annual capacity. Then we'll normally deal with that in other questions. Then now they've already calculated it for us, so there's not much worry about the previous question, but we are aware that our POR is based on the number of units that were budgeted, that were the normal capacity. The fixed manufacturing overhead absorption rate was determined at 7 Rand per tile for the previous financial year. Let us stop there, very important. The predetermined overhead rate was determined at 17 Rand per tile. Remember, this is fixed per unit from the previous year. Let's go back now. What does this mean? That means the opening inventory, which is given as 104,000 and 56,000, does not include fixed cost. So now they are telling us that the fixed cost per unit of the previous year was 17 Rand. Therefore, now we can say under these opening units, we need to multiply by 17 Rand and adjust our opening inventory so that it can include the fixed cost. Why must our opening inventory include fixed cost? Because the company is now using absorption costing, and absorption costing says fixed cost must be added in the calculation of the cost per unit. So now together with this 800 units, we multiply this by 17 rands. Multiply this by 17 rands. Therefore, now we are able to say 17 by 1800, we get to 30,600 plus 104,400. This gives us 135,000. That means now our opening inventory is inclusive of the fixed cost. That means our opening inventory is adjusted to fit the absorption costing method, meaning our opening inventory is modified to the absorption costing system that the company has just adopted. Then after we say now 17 rand, multiply this by the 800 units. Then after we say this is giving us 13,600 plus 56,000 rands. And this will give us opening inventory 69,600. This is the adjusted opening inventory according to the absorption costing system. So now very clearly our opening inventory, we know that for this first product it is 135,000, for the second product 69,600 rands. Then we can say plus 135,000, we get to a total of 204,600 rands. This is a very important question that I love, more especially the trick in this question is very crucial to be mindful of. Now we have highlighted that. Let's go to the second part of that same sentence. And if you look at this too, I highlighted this one because I knew what does it mean, and I also highlighted this one because I knew that there's a link between this one and the previous information. Now currently the fixed cost per unit is 18 rand. So now when we deal with the cost per unit of the current year, this is the amount that we are going to be dealing with. Now allow me to calculate the cost per unit. First of all, I want to calculate the cost per unit for each of these products. Cost per unit for Kilimanjaro and Amazonia. Then this will be direct material. Remember, I'm looking at the actual cost. This is actual cost that I'm looking at, not any other cost, the actual cost that I want. So now what is my actual cost? I go to my number 2, 3, 4, 5, 6, 7, all those information that were given, more especially starting number 5, because number 4 does not have the cost price backwards. Number 5, we had the, if you look at me now, I'm focusing on the second sentences. The related actual cost of material was 32 rand and 38 rand for Kilimanjaro and Amazonia. This is the direct raw material, remember. Now I'm looking at the actual only, 32 rand and 38. 32 rand and 38 rand. Then we go to the direct labor. Direct labor cost. My direct labor cost, it is also very clearly stated that the actual direct labor time was 32 minutes for Kilimanjaro and 36 minutes for Amazonia. The budgeted and the actual direct labor rate per hour were equal. That means the rate is still 30 rand. The only thing that was not as budgeted was the time. So now they spent 32 minutes and 36 minutes for Kilimanjaro and Amazonia respectively. That means what will be the direct labor actual time for each product? It will be 32 divided by 60, multiply this by the rate per hour, which gives me 16 rand 15.99. So I'll round it off to 16 rand. Second one is 36. 36 over 60, multiply this by 30 rand, it gives me 18 rand per unit, meaning time per hour multiplied by the time it took to complete the product. So that is also another information to be noteful of or to be mindful of. So now that I've made it very clear once again, then we go to the Next one. Next one is number 7. The actual cost per tile equal to 11 Rand for Kilimanjaro and 13 Rand for Amazonia. Which cost are we talking about? Variable manufacturing cost. It was actual 11 Rand and 13 Rand. I'm looking for the actual. Variable manufacturing overhead. It is 11 Rand and 13 Rand, the actual ones. Let me check, verify that 11 Rand and 13 Rand. That is the actual for Kilimanjaro and Amazonia. So we look for the second or for another cost. Let us continue on that note. The budgeted and the actual packaging cost was 8 Rand and 10 Rand for the Amazonia. At the end of the manufacturing process, tiles are packed in boxes and then sold to the wholesalers and retailers as they're supposed to be. So here the budget was the same as the actual 8 Rand and 10 Rand. So now our packaging cost was estimated very well. Packaging cost 8 Rand and 10 Rand. Let's look for another cost. Another cost, remember, it is the 4% of the selling price and the 5% of the selling price, which is our selling and distribution, is the 4% and 5% of the sales price of the products that we are dealing with. So now we need to look for the actual selling price. Our actual selling price, 4% of this will be variable selling and distribution, and 5% of this will be variable selling and distribution cost. So let me calculate that one immediately. 105 multiply this by 0.04, I get to 4 Rand 20 cents, and for this one it will be 118 multiply this by 0.05, I get 5 Rand 90 cents. Now that should be kind of very clear in terms of how this calculation gets to be calculated. So now our selling and distribution, remember, it is not a production cost, it is a non-production cost. Be mindful of that too. Now let me not add it in our production cost because it is not a production cost. So also be mindful of that. Don't just add all the cost because some of them have nothing to do with the production, although they are the cost of the entire operation. So there is no other production cost except the 18 Rand of the fixed cost for the current year. Now I want to just highlight one thing. Remember, if we add all this cost, they will give us what is called marginal cost or direct cost or variable cost. That means if you end here, you only get marginal costing income statement costs to be used. That means if we're doing marginal income statement or the variable income statement, we'll only take all this cost, then after we are done and dusted. But now because we are using the absorption income statement, we need to add our fixed cost per unit. Our fixed cost per unit, it is 18 Rand for the current year for all these two products. Then what do we do now? We say 32 Rand plus 16 Rand plus 11 Rand plus 18 Rand plus 18 Rand, also plus 8 Rand plus 18 Rand plus 8 Rand plus 18 Rand. This gives us 85, and this is the 85 Rand per unit that we are calculating. Then now we have 38 plus 18 Rand plus 13 Rand plus 10 Rand plus 18 Rand. This gives us a total of 97. Let me just recalculate the first one. 32 plus 16 plus 11 plus 8 plus 18. This is 85 Rand per unit. This is absorption cost. Now sometimes you might not need to use this format where I calculate one cost per unit, because When this is incorrect, then it becomes a problem. But there should be marks allocated, in fact, for taking this cost per unit. It's very important sometimes to calculate your cost per unit here. What do I mean by calculating cost per unit? You can say for Kilimanjaro, how many units were manufactured? 22,500. 22,500 throughout. 22,500. For this one, the units that were actually manufactured, 20,000. Multiply this by 20,000. Multiply this by 20,000. So you can do this and you record individually, material separately, labor separately. That means if you do that, you will not have this line called production cost. You will have your cost of sales made of opening plus direct material plus direct labor, and you write the amount of labor plus manufacturing overheads according to the calculation that I've done, meaning according to the total that you're getting here, labor, packaging cost. But this approach becomes very long, but it's good for grabbing of all these small marks that you would have calculated and got them accurate. But I just prefer to take this one amount and multiply it with 22,500 and this one amount multiplied with 20,000 rands, because if you deal with the individuals, they will still give you the same amount at the end of the day. So now allow me to just do it in the manner that I'm already working it out with, which is saying production. Then now when it comes to my production, I will just have to say my production will be 85, multiply this by 22,500. How much do I get? I get 1,912,500. Second one is 97, multiply this by 20,000. I get a total of 1,940,000 rands plus 1,912,500. This gives me a total of 3,852,500. Now, where is the 20,000 and 22,500 coming from? Remember, this is the number of units that were actually manufactured. Let us look at the actual manufacturing volumes for the quarter: 22,500 for Kilimanjaro tiles and 20,000 for Amazonia. So that is where all this is coming from. Then now we have to say our closing. We already know that our closing units was 1.3 for all of them. If you remember, I wrote it here, 1,300. Opening of 1.8 plus production minus actual sales. And again, opening of 800 plus production minus actual sales of 19.5. That will give you the 1,300 as closing units for both of the products. What then do? I say my closing inventory, it is 1,300 at 85 rand per unit. Then this gives me a closing of 110,500. Second one, we have 97 by 1,300. We get an amount of 112. 126,100. 110,500. We add the two, it gives us a total of 236,600. 236,600. 236,600. Now, if this is done, then we can calculate now our cost of sales. But we need to be aware of the fact that our over or our under will not be for each of the products. Be mindful of that. It will only be for the total column. So now it will impact our cost of sales in the vice versa approach, if I may say so. But you'll see that immediately when I'm busy with that calculation. Therefore, now we have our opening 135,000 plus our production 1,912,500 minus closing 110,500, which is a total cost of 1,937,000. 1,937,000. I have not calculated my sales. I don't know how I forgot, but I'll do so. We have 69,600 plus 1,940,000 minus 126,100. It is a cost of sales of 1,883,500. Then after we say, now we have calculated all this, we need to now do what is called the predetermined overhead rate, where now we compare our actual with the applied. Our actual with the applied. Our POR, remember, it is 18 Rand. We need to multiply this by the actual production. Now let us look at that information. We have our, just erase this, then now we come to our actual fixed cost. Our actual fixed cost, we have fixed manufacturing overheads. Our fixed manufacturing overheads, it is 776,000. Then now we need to calculate our applied for each of the product. Our POR is 18 Rand. 18 Rand, multiply this by 22,500, and 18 Rand multiply this by 20,000. Then we add the two, it gave us applied. This POR term by actual production, remember, 22,500 by 22 by 18, we get 405,000. Then after we say 18 by 20,000, it gives us 360,000 plus 405,000. We get 765,000 minus 776,000. We get 11,000 as our over or under. What have I just done? Remember, for me to calculate what is called applied, what we call applied, this is what is called applied, meaning we are calculating our cost based on the actual figures. We say POR times by actual production. POR is 18 Rand for the year, actual production 18 Rand for the current year, actual production. We get to our applied, and this is our total applied for all the products. We compare it with the total actual fixed cost for two products, because they did not separate our fixed cost actual. This is not separated, it is one amount. So that is where now that 11,000 is coming from. We had 405,000 plus 360,000, which gave us 756,000, if I'm correct. 756,000 minus 776,000, that will be 360,000 plus 405,000, or 765,000. It was 765,000 minus 776,000. That's where the 11,000 come from. We estimated that fixed cost will be 765,000, but they were more than what we anticipated. So this should be increasing the cost of sales. Remember, increase in the cost of sales is the decrease in the gross profit. Let me hold you there. Increase in the cost of sales is the decrease in the gross profit. So the 11,000 should be increasing the cost of sales, which will be a decrease in our gross profit. So now this will be recorded as negative. It will be recorded as negative 11,000 because we don't have it for each of the product. We don't have our fixed cost for each of the product. At the same time, we don't have our fixed cost for each of the product, fixed manufacturing cost for each of the product. So now hence this will appear here as 11,000 rands. Then after we'll get to our gross profit. So then the total of these two will be 1,937,000 plus 1,883,500, which is 3,820,500. 3,820,500. Then let me come to my sales now that I've been forgetting for a long time. Selling price, actual selling price 105 and 118. Actual sales 23,019.5. We have 105 times by 23,000. This gave us 2,415,000. 2,415,000. Then we go to 118 by 19,500. We get to 2,301,000 plus 2,415,000. We get to 4,716,000. 4,716,000 rands minus 3,820,500 equals minus 11,000 of that under applied overheads. We get to our gross profit as 884,500. Then after we have our selling and distribution. Remember, our selling and distribution is non-manufacturing cost. Selling and distribution, we're looking for the actual information. That's all. Always actual, because we are required to do the actual information regarding our sales and distribution. Sales and distribution, there is actual one 431,600, actual 431,640, 431,640, 431,650. My mind is getting tired. Yes, 431,650. Therefore now we will get to our actual net profit. Actual net profit. I want to highlight the fact that packaging cost, it is the cost to package a product, meaning we cannot sell a product that is not packaged, meaning it is for us to manufacture a complete product, we need to package it. So our packaging cost is part of the manufacturing cost. 884,500 minus 431,650, we get to 452,850. Then this becomes our actual net profit according to the absorption costing. Just one thing to highlight, remember in this case, this is over or under applied recovery rate or recovery. or absorption cost, the 11,000 is under applied. And we know that when we have under applied, that means we must increase the cost of sales. And increase in the cost of sales will reduce our revenue or reduce our gross profit. That is why I said sales minus this amount minus 11,000. Otherwise, this can be, you can say plus here increase your cost of sales. And increase in cost of sales is reducing your gross profit at the end of the day, or reducing your revenue. So now be mindful of that, and it's because we don't have the over or under for each product is for all the products, hence it only goes under the last one column. Guys, with that, thank you very much. You've been lovely listeners. God be with you. Thank you.